Hello and welcome to Global Business Insights, where we bring analysis on the main business headlines. As US markets opened, Meta was already up 16% as the news of the first ever dividend was seen as a coming of age landmark moment for the Facebook parent, with a $50 billion share buyback program on top of beating earnings expectations, plus announcing a better guidance for the current quarter. It couldn't be better. Layoffs helped the stocks to stay afloat, but the transition to a dividend paying company now seems to be providing new momentum. Apple was the obvious laggard today, opening down 2.3% on the narrative of a major slowdown in China, and not helped by a launch of its new Vision Pro headset in the US. We thought that would provide a little upward push there, but apparently not. Apple still opened in negative territory. Analysts also say the performance of the so-called Magnificent Seven is by no means reflective of the broad sentiment, especially when you consider small caps. But even for the Magnificent Seven, the bar most likely is going to get even higher. Unlike the Dow and S&P indices that's an all-time high, and the Nasdaq also close to one, the Russell 2000 was down 1.42% on open, and it's actually 15% below, way below an all-time high. That was in June 2021. The Russell 2000, that's an index of 2,000 small cap companies, is widely used as a benchmark for US small cap stocks. Also, we look, of course, at the just released non-farm payrolls data, where we saw a stunning beat, pointing to a resilient economy and a tight labor market. We discussed Apple's results. We did that also in the earlier episode, and the latest IMF Global Economic Growth Outlook, which came out yesterday. Non-farm payrolls came out with an exceptional beat, with jobs added rising to 353,000 in January. The previous month, December reading, was also upwardly revised from 216,000 to a 333,000 increase, surpassing market expectations of about 180,000 by a very comfortable margin. If you factor all the previous revisions, employment in November and December combined is 126,000 jobs higher than previously reported. The report also says that job gains were in professional and business services, healthcare, retail trade, and social assistance, while employment declined in the mining, quarrying, and oil and gas extraction industry. Unemployment rate was steady at 3.7%. Labor force participation rate also unchanged at 62.5%. Wage inflation, that's the change in average hourly earnings, inched up to 4.5% on a yearly basis, higher than market expectation of 4.1%. On a monthly basis, hourly earnings went up 0.6%, double 0.3% expected, and last month 0.4%. So what do we make out of this? Jobs added almost doubling expectation, while wage growth also almost doubling what was expected, can only suggest that the chance of a rate cut in March is most probably nil. The Fed will obviously prefer to wait out a longer period to ensure inflation has well abated, especially core inflation, and ensure prices are broadly lower and not just low in certain pockets of the economy. Meta shares opened at 16% higher. That was when the New York Stock Exchange opened. It kept rising. As we speak, it's now about 17:00 GMT, just after midday in New York. It's 21.2%, and it looks like it's still rising, even as investors applauded that first dividend award, also applauding a generous buyback and the guidance, which was also decent. Markets are pleased that Meta has joined the dividend payers, but I still see the likes of Meta perhaps in need of a strategic collaboration that can better leverage its formidable 2.11 billion active users. That was actually better than 2.08 that analysts had expected. On artificial intelligence, Meta admits they do not see generative AI products as a meaningful 2024 driver of revenue, adding that near-term monetization opportunity is with ad creative tools and investors. Of course, like I said, quarter revenues expected to be between 34.5 billion to 37 billion, higher than consensus of a rise to 33.9 billion. So, like I said, investors were happy with that guidance as well. And Apple was penalized by markets as it disclosed a major loss in market share in China. Earlier in the day, we spoke on Apple's results released yesterday. As we speak, Apple is down 0.25%. Some of the losses, apparently it's recovered, but still in negative territory as at midday in New York. First, we look at Apple as it reported December quarter earnings yesterday that outperformed estimates for both revenue and earnings. And this despite a 13% decline in China, one of its most important markets. The loss of market share in China, certainly a red flag for analysts, and its shares fell after hours by about 2.9%. We'll see what happens when markets open. Revenues came in at $119.58 billion compared to $117.9 billion estimated, and earnings per share at $2.18 also beat estimates and up 16% to an all-time high, behind estimates. The most important factors that investors are looking at now are first, the impact of artificial intelligence and the commercial trajectory for new game-changing innovation as AI is embedded into all the products we are used to. Apple's approach seems to be very pragmatic. They're embedding AI in their devices that markets are already using, and with talk of a new device also around. But a previous foray in metaverse and a wide array of wearables makes one wonder if Apple is spreading itself too thin. Will artificial intelligence help it to evolve the new groundbreaking gadget? That's not so clear. Artificial intelligence could easily enable a new player to bypass the big tech giants, completely upending the market as innovation cycles and costs are increasingly lower. Contract manufacturers such as Foxconn no longer work only for big clients like Apple. Some offer dedicated services for hardware startups as well. And Apple's advantage in terms of its R&D budget and its relationship with Foxconn and others may not be as compelling in today's environment. Still, on artificial intelligence, CEO Tim Cook hinted late Thursday afternoon that the company would make an important AI-related product announcement later this year. Also, another issue is about how long can cash cows keep producing the milk, and can Apple replace the iPhone with something different, which customers cannot live without. Today, there is some excitement about initial orders for the just launched Vision Pro mixed reality headsets, but they just start shipping today, so it's early to comment. Apple Vision Pro launches with over 600 apps and games designed specifically for the new headset. The new VR, AR headset and new devices aim to do away with screens, keyboards and mice, and they use generative artificial intelligence to improve the experience with users as they get better at being controlled by eyes, voice and hands gesture rather than touch. But so far, this is catching on mainly only for gaming enthusiasts, and I doubt if the familiar mouse, screen and keyboard are disappearing soon. We'll see if the Vision Pro launch helps to take the focus off the market loss in China. iPhone sales grew nearly 6% to $69.7 billion, slightly under expectation, but good enough. A challenged economy and rising youth and unemployment in China certainly is not helping matters, and Apple is pivoting more to India, Vietnam, and other high-growth emerging economies with high disposable income and less local competition. Still, the sheer scale of devices out there, which keeps growing and also strongly integrated in a formidable ecosystem, is an advantage that regulators want to break as they relax barriers for other smaller players like app developers. And Apple, of course, wants us to live in their devices. 2.2 billion active devices in use, up from 2 billion devices last year. A lot of market power. The wearables business, sometimes called other products, that's AirPods, headphones, and the Apple Watch, declined 11% on a year-on-year basis, far from replacing the iPhone as the money spinner. Other things markets are looking at is cost management. Apple gross margins are improving, reporting 45.9% higher than initially estimated. But Apple needs a winner, a new winner, and quickly. The innovation, quality, and differentiation DNA has to deliver a new iconic product, or the competition will. I think the era of exceptional growth for Apple may be over as we all wait for that new super gadget to hit the market. Yesterday, the IMF warned banks not to go too quickly on rate cuts. With the hot economic data and tight jobs data recently in the US, it's unlikely that rate cuts are coming soon, as many now see perhaps June, depending on the trajectory on the inflation, jobs, and growth rate. The IMF slightly upgraded its forecast for global growth, now to be at 3.1% in 2024 and 3.2% in 2025. The 2024 forecast is 0.2 percentage points higher than the October 2023 forecast. Why? Mainly greater than expected resilience in the US, improvements in several large emerging markets and developing economies, as well as fiscal support in China. Three things I saw from yesterday's IMF Outlook update. First, it sees growth shifting to developing economies and emerging markets. Advanced economies will grow by 1.5% in 2023, while developing economies will grow more than double that at 4.1%. China will grow at 4.6%, Sub-Saharan Africa at 3.8%, Nigeria 3.1%, and South Africa 1%. There is an opportunity for developing economies to introduce reform to de-risk their economies and rethink incentives to attract investment as the radar returns to these regions. Second, the IMF sees less chance of hard landing, warning that central banks should not be hasty in cutting rates too soon and not too late as well, paying close attention to data triggers and recognizing new potential shocks emerging from the geopolitics, which we know can easily derail the track to bring inflation down. Thirdly, the IMF warns of the need to learn from the last 3 years, with inflation declining and economies better able to absorb effects of fiscal tightening, and countries need a renewed focus on fiscal consolidation and rebuilding budgetary buffers to deal with future shocks, while also raising revenue for new spending, people-oriented priorities, and of course curbing the rise of public debt. For emerging economies and sub-Saharan Africa, whitewashing cracks and premature celebration of thin economic victories has led countries like Ghana to see that if more fundamental reform and not enacted and buffers rebuilt, future shocks can take countries back many steps after progress. And countries like Nigeria need that long-term focus to restructure spending, build buffers, and enact far-reaching reforms that will re-establish much stronger foundations for growth. And while there are quick wins, leadership must understand the real battle is fought and won on a multi-year front. And to update you on some of the stocks we discussed, Apple down 0.16%, Meta up 21.28%, Amazon also up 8.02%. Well, that's it from me. This is Bode Oshosami, and thank you for watching. Enjoy your weekend. Bye-bye.